You're watching Silver News Daily. Subscribe for more.
Did you know that the world's silver vaults are being drained faster than ever before? Asia is stockpiling like there's no tomorrow, and Western inventories are running dry. Here's the kicker. This could lead to a historic silver price explosion in 2025, and nobody's talking about it. Stick around to discover why this may be your last chance to secure silver before it's out of reach. Trust me, you won't believe what's coming.
The yield on that going over 5%. At the moment it is rising, and if you look at the chart, actually, the chart's very interesting because you've got a golden cross underneath the yield. Rising yield, so it's all going in the, in a bullish formation, which tells us that yields are going to rise. And so why would this be? Well, I think the answer actually is very, very simple. We have obviously a new president from sometime in January, can't remember quite when, and that new president says that tariffs are the most beautiful word. What he intends to do is, as much as possible, to replace income and corporation taxes, or at least reduce them, and compensate by raising tariffs. Now, raising tariffs, apart from the effect on the global economy, which will tip it into depression, quite frankly. This is Smoot-Hawley Mark II, potentially. Not only that, but you're going to see consumer prices in the United States rise. So what does the Fed do? The Fed can't reduce interest rates more than what it'll do this week. I mean, it's expected to do a cut this week. Quite frankly, if I was Jay Powell, I'd say no, just sit on it for now. But so interest rates is the answer to your question. That is the thing we've got to watch. And I would say that if we see that US Treasury 10-year note yield go over, say, something like 4.75% to 5%, then alarm bells will be ringing very, very clearly. And I would suspect that it will be the end of the bubble, the end of the asset bubble. Take out equities, it'll also take out, and this is maybe controversial to a lot of your listeners, it'll also take out the crypto bubble, particularly Bitcoin. I can see that collapsing along with equities. Because apart from anything else, it correlates very, very nicely with NASDAQ. It's the same cohort who go for the Magnificent Seven. They're the guys who are also buying Bitcoin. And okay, Trump's bullying it up a bit with a few comments and all the rest of it. But as soon as he gets into office, it'll be made absolutely clear to him that you do not promote Bitcoin because all you do is undermine your own currency. So that's
Let's
that's
talk about
basically
something that should
the
be
answer to your
front-page
question.
news: the massive depletion of silver reserves in Western vaults. COMEX, the world's largest silver futures exchange, has seen its registered silver inventory, silver that's ready and available for delivery, plummet to a 5-year low. Just last year, it was sitting at over 50 million ounces. Today, it's barely scraping 38 million. That's a 24% drop, and it's not just COMEX. This is a trend that's echoing across the globe. Now, you might hear people saying, well, there's still plenty of silver in the eligible category, but here's the problem. Not all eligible silver is what it seems. Eligible silver is technically stored in COMEX-approved vaults, but much of it is locked away by long-term investors who have no intention of selling or trading it. In fact, COMEX itself admitted that at least 50% of eligible silver can't realistically be considered deliverable. So when you crunch the numbers, the amount of silver truly available is shockingly small. Meanwhile, the London Bullion Market Association, or LBMA, is facing a similar crisis. Over the past 10 months, their silver holdings have dropped every single month. Today, they're at record lows of just 871 million ounces. To put this into perspective, that's down nearly 50% from their peak inventory levels in 2016. Even the LBMA itself admitted that increased client demand is leading to significant physical silver exports, most of which are heading straight to Asia. Here's where it gets really alarming. When you combine the shrinking inventories with skyrocketing demand, you're left with a recipe for a potential supply crisis. And it's not just a theoretical issue, it's already happening. Massive amounts of silver are being pulled out of vaults to meet the demands of futures contracts, and the gap between what's available and what's promised is only widening. So why does this matter? Because as supply continues to dwindle, prices could be pushed higher, potentially much higher, especially if demand keeps growing. And with silver's role as both a critical industrial metal and a store of wealth, the stakes couldn't be higher. Have you been paying attention to the shrinking silver supply, or is this the first time you're hearing about it? Drop your thoughts in the comments. Let's get the conversation going. And if you haven't already, hit that subscribe button because we're just getting started.
Interest rates are completely under the control of the central banks. They're not. Interest rates are rising, and they're rising for two reasons. Firstly, governments are in debt traps, so that the level at which you fund government debt inevitably means higher yields. And the second thing is that with most economies stalling, in 2025, banks see increasing risk lending into the private sectors. Now, an individual bank can reduce its credit exposure, reduce its balance sheet, but it can only do that if another bank or other banks increase theirs. Unless, of course, you get non-performing loans, in which case debt gets written off and deposits on the other side also get written off. And the other thing, I suppose, is if banks themselves go bust, then their whole balance sheet is taken out of the credit system, disappears. The central banks will do whatever they can to ensure that the latter doesn't happen. And they will also try and ensure that bad debts in the economy don't happen enough to disrupt things, if you like, simply by trying to suppress interest rates. But it doesn't work. It's not going to work. Now, this is very important because the level of bond yields, if they're going to rise, they will undermine the credit bubble as a whole, and particularly equities. Equities will crash. And I think this is a very important point. So, really, to answer your question, I think central to all this, central to the value of markets in 2025, is this interest rate outlook. And I have to say that people have got this entirely wrong. Now, having said that, you can see that if you look at the US Treasury 10-year, which we take, if you like, as the sort of marker for global bond markets, that's meant to be the risk-free. Risk-free, I mean, honestly, these guys have got no idea. But anyway, that's meant to be the risk-free bond. I can see...
Now, let's shift the focus to Asia, the region that's been quietly reshaping the global silver market. While Western vaults are being drained of their reserves, Asian countries, especially India and China, are aggressively stockpiling silver at record-breaking levels. The numbers don't lie. India alone imported a staggering 8,217 tons of silver in just the first 9 months of 2024. If we annualize that figure, it's close to 11,000 tons, about a third of the world's entire annual silver supply. And it's not just India. China is making waves too. Known for its insatiable demand for raw materials, China is utilizing silver not only for investment purposes, but also to fuel its industrial growth. Silver is a critical component in renewable energy technologies, including solar panels, a sector where China is the undisputed global leader. With renewable energy investment surging, China's appetite for silver is only intensifying. But why is this happening now? A big part of the story lies in cultural and economic trends. In India, silver has always been a traditional investment, viewed as a store of wealth, especially in rural areas where people trust precious metals more than banks. Combine this cultural preference with today's soaring inflation, and global economic uncertainty. And you have the perfect storm driving silver demand to unprecedented levels. In China, the government is actively encouraging citizens to invest in precious metals. Unlike in the West, where people might turn to cryptocurrencies or stocks during times of economic instability, many Chinese citizens see gold and silver as the ultimate safe havens. Banks in China even allow citizens to hold gold and silver accounts, making it easier than ever for individuals to invest in physical silver. And let's not forget the role of geopolitical factors. With rising tensions between East and West, Asian nations are looking to diversify their reserves away from the US dollar and other Western financial instruments. For many, silver, and to a greater extent gold, represents financial independence and security. This unprecedented demand from Asia is not just a temporary phenomenon. It's reshaping the global silver market in real time. The sheer volume of silver being pulled into Asian markets is creating a supply squeeze that could lead to price surges in the near future. So what do you think? Could Asia's insatiable demand for silver be the driving force behind the next big price explosion? Let us know in the comments. And don't forget to subscribe for more insights. You won't want to miss what's coming next.
To the situation over debt, over the stability of credit in terms of its value. Now, clearly, there are central banks around the world who look at the relationship between gold and currency and basically want to get rid of their currency reserves and replace it with gold. What are they doing? Are they buying gold? No, actually, what they're doing is they're getting out of currency. They're getting out of credit. This is the key point. And this is also very much what the People's Bank of China has been doing. And it's being emulated by Chinese nationals, Chinese citizens, who not only take delivery of gold and bars out of the Shanghai Gold Exchange system, but they also run gold accounts at their banks. And with the People's Bank of China having reduced interest rates a little bit recently, the alternative attraction, which is bank deposits, the Chinese housewife will take out a 3-year deposit in order to maximize the interest return. That's all coming down. So, of course, on a relative basis, it makes gold a lot more attractive. And bear in mind also that any Chinese national trying to hedge out of his currency can only do it in gold, because he can't go and buy dollars, buy euros, buy Canadian dollars, whatever. Can't do that. So, gold is the only thing they can do. And, of course, Russians now can go and buy gold. I mean, they can run a gold account at their banks. So this is a world which is moving towards gold while we've been moving away from it. I mean, we're asleep, if you like, while this is going on. So anyway, that I believe is what's going on. I mean, basically, we're getting to the point where there is so little gold in the West now. And of course, the next thing is that when people wake up in the West, say, "Oh, we better have some gold," they run out and buy ETFs. What's that going to do to prices? I mean, I think it's a one-way ticket.
While Asia is hoarding silver and Western vaults are running on fumes, there's another critical piece to this puzzle: rising U.S. Treasury yields. At first glance, you might think higher yields would hurt precious metals like silver, but here's the catch. It's actually setting up one of the most bullish cases we've ever seen. Let's unpack this. U.S. Treasury yields have been climbing steadily, with the 10-year yield recently hitting levels not seen in decades. Why does this matter? Because higher yields usually attract investors to government bonds, which are considered safe, and away from non-yielding assets like gold and silver. But this time, it's different. Rising yields are creating a perfect storm for silver in 3 major ways. First, higher yields are a direct reflection of growing debt concerns. The U.S. government is buried under $33 trillion in debt, and as yields rise, so does the cost of servicing that debt. Investors see this and are starting to question the long-term stability of the dollar. What's their hedge against this instability? Precious metals like silver. Second, higher yields are crushing stock and crypto markets, driving investors towards safe havens. Rising rates are putting immense pressure on risk assets, creating what some are calling the Great Rotation. In times of chaos, silver, with its dual role as both an industrial and investment metal, becomes incredibly attractive. Third, and perhaps most importantly, silver thrives during periods of economic uncertainty and rising inflation. And let's be real, the inflation story isn't going away anytime soon. Even though central banks are trying to cool inflation with higher rates, the knock-on effect is higher costs across the board, from consumer goods to borrowing. This is making silver's role as a hedge against inflation more critical than ever. But here's the wild card. While the rising dollar might seem like bad news for silver, it's actually masking the underlying fragility of the financial system. The dollar's strength is creating artificial pressure on silver prices, but once that strength reverses, and it will, it could unleash silver's full potential. Here's the big takeaway. Rising yields might seem like a headwind for silver, but they're actually a signal of deeper economic issues that could make silver a must-have asset in the years ahead. This is the moment to start paying attention, because when the tides shift, those holding silver will be ahead of the curve. Now, let me ask you if you think the bond market's instability could be the final spark that ignites a historic silver rally. Drop your thoughts below and let's discuss. And if you haven't yet, hit that subscribe button, because we're just scratching the surface.
I'm taking delivery now. Well, not everyone, but I mean, you can see that there are huge quantities standing for delivery. And I think a lot of it is there is such demand for gold, particularly from Asia. We can talk about that a little bit, what's driving that. But there is such heavy demand for gold that they're even going in to try and sort of get the loose holders out of futures. So it's a bid-only market in effect for physical. And the only way you can get physical, go along to a refiner and say, when can you let us have some gold? They say back of the queue. If you go to, start dealing in the forward market in London, then you might be able to get some. But the amount of liquidity in the vaulting system, in the LBMA's vaulting system, I guess is extremely low. I mean, it shows that they've got, however many thousand tons, but, in practice, very little of that is really available, if you like, to satisfy market deliveries. And we've got the same situation in COMEX. Again, you've got quantities there which are basically not really available for delivery. I mean, some of them may be registered for delivery, some of them may be eligible for delivery, all that sort of stuff. But, the reality is that the liquidity in these markets, in Western markets, is drying up because of demand from Asia. And it's running into that brick wall. And I think this is why you've got these enormous quantities. I mean, 69 tons of gold is not a trifling amount. I mean, this is very, very serious stuff. This is more than most countries' gold reserves, since stood for delivery on the December contract, on the expiry of the December contract. And also, it seems in its dying days, you see people going out and buying the December contracts so they can take delivery. I mean, this is, honestly, Jesse, this is an extraordinary situation. And I think it does tell us that there are strains in the market. Now, we can't know precisely what those strains are, but this is the sort of thing I would expect to see ahead of a fairly significant move up in gold.
Silver isn't just a precious metal, it's an industrial powerhouse. Right now, we're seeing a seismic shift in how silver is being used, and it's all tied to the booming renewable energy and tech industries. This transformation isn't just driving demand, it's creating a supply squeeze that could redefine silver's value in the years to come. Let's start with renewable energy. Did you know that nearly 20% of global silver demand now comes from the production of solar panels? That's because silver is absolutely critical for photovoltaic cells, the technology that converts sunlight into electricity. Its unmatched conductivity makes it the most efficient material for this purpose. With governments around the world pouring billions into green energy projects, solar panel production is surging, and with it, the demand for silver. In fact, the International Energy Agency predicts that solar energy capacity will surpass coal by 2027, and this trend is accelerating as nations race to meet their renewable energy targets. But here's the issue: the silver supply isn't keeping up. Mines are struggling to increase output, and with the market already in a structural deficit, it's clear that we're heading for a major crunch. And it's not just solar panels driving this industrial demand. The electric vehicle revolution is another major factor. Advanced vehicle technologies from powertrains to sensors and charging stations rely on silver. As EV adoption continues to grow, at an annual rate of over 22% globally, the amount of silver needed for these applications will skyrocket. But wait, there's more. Emerging technologies like 5G infrastructure, artificial intelligence, and even advanced medical devices are increasing their reliance on silver. For example, high-performance computing systems and next-gen hardware require silver's exceptional conductivity to handle massive amounts of data and heat. And let's not forget silver's antimicrobial properties, which are being used in medical equipment and water purification systems worldwide. The numbers speak for themselves. In 2024, global industrial demand for silver reached a record-breaking 700 million ounces for the first time in history. And this is happening at a time when new mining projects are limited and existing mines are producing less due to declining ore quality and stricter environmental regulations. What does this mean for prices? With demand soaring and supply struggling to keep up, we're looking at a classic supply-demand imbalance. Analysts predict that this could push silver prices to levels we haven't seen in decades, potentially over $1.40 an ounce in the near future. So here's the big question. Can the renewable revolution and industrial tech keep up their pace without causing a silver supply shock? And if the answer is no, are we prepared for the consequences? Let us know your thoughts in the comments, and don't forget to subscribe for more deep dives into the silver market. Trust me, you don't want to miss what's coming next.
Since Thanksgiving, it's 69 tons of gold and 1,324 tons of silver. Now, obviously, we don't know for certain who is standing for delivery. It strikes me that there must be many parties involved. So who could it be? I mean, you can see that in America, the people who are bullish for gold are really in a very tiny minority. The other thing is that if you look at the exchange for physical numbers, they are actually very, very high, particularly in gold. Now, what that tells us is that effectively it's an arbitrage between COMEX futures and London forwards. The exchange for physical basically is you go out of COMEX. What you do is you go out of COMEX and you go into a forward in order to take delivery. Now, you don't necessarily take delivery, and it could be the other way. So we have no idea as to exactly what the position is in the exchange for physical. But when you get high numbers, you know there is something going on in those markets. And just to remind you, when we had the run-up, I think it was 2020, late 2020, when gold first ran up to challenge new highs, 2070, something like that, there was a crisis in the exchange for physical. And, deliveries couldn't take place between markets because of COVID and all the rest of it. And I seem to recall that HSBC said that on the exchange for physical, they lost over $200 million just on that. So this is actually a very, very serious business. The point about COMEX is that it was never meant to be a delivery market. I mean, the concept of a future is that at expiry, you have the option, if you like, to either sell your future, in which case the position closes out, because for every long there's a short. Okay, so it closes out. Or alternatively, you can take delivery. But because it's a very highly leveraged market, the players in futures almost never take delivery. So why is everyone?
Let's dive into one of the most unpredictable yet powerful forces driving silver's potential: speculation. Right now, hedge funds, HEPs, and retail investors are circling the silver market, and their activity could amplify an already explosive situation. But how does speculation tie into silver's unique position as both an industrial and investment level? First, let's talk about managed money accounts, essentially the big players like hedge funds. On the COMEX exchange, these funds have been ramping up their silver futures positions. As of December 2024, they held a net long position of 153 million ounces, which is significantly above the 5-year average. What does this mean? It shows that the so-called smart money is betting on higher silver prices, likely due to the structural deficits we've talked about and the surging industrial demand. Now, let's shift to ETF. Exchange-traded funds like the iShares Silver Trust, SLV, are massive silver holders, and their activity often mirrors the sentiment of retail and institutional investors. As of late 2024, silver ETF holdings stood at 712 million ounces. That might sound like a lot, but here's the kicker. It's still below the 5-year average of 792 million ounces. This means there's room for significant inflows, and if investors start piling in, it could send silver prices soaring. Here's where things get interesting. Speculation often feeds on momentum. When prices start to rise, speculators jump in, accelerating the trend. This creates a feedback loop where higher prices attract more buyers, which in turn pushes prices even higher. We've seen this before during the infamous silver squeeze movement in early 2021, where a surge of retail buying sent prices temporarily skyrocketing. But this time, the stakes are even higher. Unlike in 2021, where the silver squeeze was largely driven by social media hype, today's market is underpinned by undeniable fundamentals, dwindling inventories, skyrocketing industrial demand, and a looming supply crunch. If speculators jump in now, they're not just riding a trend. They're amplifying a crisis that's already in motion. And it's not just professional traders. Retail investors are also keeping an eye on silver as a hedge against inflation, currency devaluation, and geopolitical instability. This dual narrative of silver as both an industrial necessity and a financial refuge is creating a perfect storm for speculative activity. So what happens if this speculative surge hits? Prices could see extreme volatility, with sharp spikes driven by panic buying and sudden corrections. But in the long term, the fundamentals we've discussed will likely prevail, meaning the overall trend could still be upward. Here's the question. Are we on the brink of another speculative mania in silver, or is this the start of a more sustainable rally backed by real-world demand? Let me know your thoughts in the comments below. If you're finding this breakdown valuable, don't forget to hit that subscribe button for more insights. Trust me, don't want to stay ahead of this story.
To take the pressure off malinvestments, off the zombies, if you like, off banks which may be over-leveraged for those conditions and face substantial loan problems, if you like, bad debts. Take pressure off markets. I mean, ever since Greenspan, he was talking about you've got to keep the stock market bubbling, take the pressure off the stock market. So you've had bubble after bubble after bubble, and we are now finally in the largest bubble ever known in history. This is larger than John Law. It is larger than South Sea bubble. This is the big one. It is larger than the dot-com bubble. And I remember the human psychology in the dot-com bubble was exactly the same as You read accounts of, the Mississippi bubble and the South Sea bubble and the tulip mania and all these bubbles. I mean, it was up there with the extremes. This is twice as big. I mean, when this bursts, it is going. I mean, there is nothing, absolutely nothing, any central bank can do about it, because by reducing interest rates this time, they just collapse their currencies. That is really how serious this situation is. And I think that we're likely to see this develop in 2025. The only way out of it is just get the hell out of credit. And if you're going to get the hell out of credit, what do you go to? Well, the only thing is real money, which is gold, and to a lesser extent.
Let's turn our attention to two major players in the silver market, the COMEX in New York and the LBMA in London. These institutions are the backbone of global silver trading, but recent trends are raising alarm bells, and the implications could be catastrophic for the market. First, the COMEX. Known as the world's largest silver futures exchange, the COMEX has long been a key hub for price discovery. But here's the problem. The physical silver inventory available for delivery is collapsing. As of late 2024, the registered silver category, silver ready for immediate delivery, stands at just 38 million ounces, the lowest level in 5 years. For context, just a few years ago, this figure was comfortably above 50 million ounces. But that's not the only issue. The COMEX also includes eligible silver in its inventory reports, which totals around 266 million ounces. However, a bombshell revelation from 2021 showed that at least 50% of this eligible silver is held by long-term investors who have no intention of selling. When you apply that 50% haircut, the true deliverable supply on the COMEX drops to just 171 million ounces, less than 60% of what's officially reported. Meanwhile, over at the LBMA in London, the situation is just as grim. Silver inventories in LBMA-approved vaults have been declining for 10 consecutive months and are now at record lows of 871 million ounces. This is a dramatic drop from the peak levels seen in 2016, and vault operators themselves have admitted that the outflows are due to unprecedented client demand, much of it from Asia. But here's the kicker. As inventories shrink, the strain on the futures market is intensifying. In December 2024 alone, over 1,300 tons of silver were stood for delivery on the COMEX, an enormous amount for a market that was never designed to facilitate large-scale physical deliveries. The system is buckling under the pressure, and some analysts believe we're dangerously close to a full-blown supply crunch. And it's not just about inventory levels. Position limits, rules designed to prevent excessive speculation, are also under scrutiny. Currently, a single trading entity can control up to 3,000 silver contracts on the COMEX, equivalent to 11.4% of the deliverable supply. This concentration of power raises serious questions about market manipulation and whether current limits are too lax to ensure fair price discovery. So, what happens if Western vaults run dry? The consequences could be severe. Prices could spike uncontrollably, futures contracts could default, and confidence in the market could erode. In a worst-case scenario, we might even see a complete breakdown of the futures market as investors scramble to secure physical silver at any cost. Here's something to think about. If the institutions that underpin the global silver market are facing these kinds of challenges, what does that mean for the future of silver as an asset? Is this a wake-up call to start securing your own physical silver while you still can? Let us know your thoughts in the comments below. And don't forget to hit that subscribe button for more in-depth analysis. You won't want to miss what's coming next.
Yes. Now, again, this is where market commentators get the relationship between gold and yields completely wrong. They think that if you get a higher yield, it makes gold less attractive because gold yields 0 or 1% or on a lease rate or whatever. But what they ignore is the whole purpose of gold is actually to hedge out of credit. And what we're looking at in terms of credit is fiat currencies, and particularly in this case, the dollar. So if the value of the dollar starts going down in terms of its purchasing power, then gold will appear to rise. And that's basically what we face. I think that there's a complete, there's a huge error, if you like, in central bank thinking that the purpose of interest rates is to manage economic outcomes. No, it is not. I mean, if you go back to the days of gold standards, it was there basically to manage your gold reserves. In other words, if the gold reserves started going out of the door, you had to raise interest rates to make your currency, which was a gold substitute, attractive to the arbitrageurs to get the gold flowing back into your reserves. That's actually the true role of interest rates, is to stabilize the currency, not to manage the economy. And of course, so all central banks are doing completely the wrong thing. This is now basically what's happened is that by using interest rates to try and manage economic outcomes, every time there's been...
After everything we've discussed, shrinking inventories, surging industrial demand, speculative pressure, and systemic strains at the COMEX and LBMA, it's clear that the silver market is on the edge of a historic transformation. But what does all of this mean for you? Here's the hard truth. The global financial system is reaching its breaking point. Rising interest rates, unsustainable debt levels, and geopolitical instability are creating the perfect storm. The cracks are already showing, and when the next crisis hits, fiat currencies and paper assets could take the hardest hit. That's where silver comes in. Unlike fiat currencies, silver is a tangible asset with intrinsic value, a form of wealth that has stood the test of time. And unlike most industrial commodities, silver's dual role as both an investment and a critical material for technology and renewable energy gives it unmatched resilience. Consider this. If the COMEX and LBMA inventories are already this depleted while demand continues to surge, how long can the current system hold up? When Western vaults run dry and silver becomes increasingly scarce, prices could skyrocket as the market scrambles to adjust to reality. Think back to past financial crises. Precious metals like gold and silver have always served as safe havens, protecting wealth when traditional markets collapse. But silver offers something unique. Because of its industrial uses, its value isn't tied solely to financial speculation. It's not just a hedge, it's a necessity. Let's not forget about Asia's insatiable appetite for silver. With countries like India and China stockpiling at unprecedented levels, the balance of power in the silver market is shifting. As Western vaults empty, silver is flowing east, and once it's gone, it may not come back. So what's the bottom line? If you're watching this, you still have time. But make no mistake, time is running out. The silver market is setting up for a historic surge, and those who act now could secure their wealth in ways that will be impossible once the supply crunch fully hits. Now, let me ask you, will you wait until silver is out of reach, or will you take steps to secure your financial future today? Let us know in the comments below. And before you go, make sure to hit that subscribe button for more insights like this. And remember, this isn't financial advice. Always do your own research and consult a professional before making investment decisions. But if you've been on the fence about silver, now might be the time to act.
Well, Russia, obviously. I think that the public there are beginning to wake up to this. Egged on a little bit by comments from people like Sergei Glaziev and so on and so forth. Southeast Asia, very definitely. And some of the sort of Central European nations. I mean, Poland's been buying gold. There's sort of countries which don't have much gold are having to go for it. Sorry, excuse me. And this also includes, of course, the Shanghai Cooperation Organization and BRICS communities. the central banks for these nations, some of them have got gold, some of them are heavy miners, like Kazakhstan, but so many others haven't got it, and particularly also not just the associates who were appointed to BRICS in the last meeting, but also those who would see their long-term future perhaps migrating from the Western financial system into, the sort of, if you like, the Russia-Chinese Asian axis. And lots of nations are in that position. I mean, they're sort of too frightened to move too suddenly because they all owe dollars big time.